The main challenges facing banks, I think, are twofold. One is the economic situation, which obviously continues to be challenging both in the UK and in Europe, and indeed elsewhere as well. That's going to be a big challenge. And then, of course, everybody knows that the regulatory changes occurring globally pose a number of challenges for banks, and those changes occurring simultaneously. And for the largest banks, some very significant changes to their business models in the years to come, with things like the implementation of the Independent Commission on Banking's recommendations on ring fencing, Basel III, the creation of living wills. There's a whole slew of new regulations that's really changing the way in which banks operate. I think banks are well prepared. I think the challenge, as ever, if you're a senior individual in a bank, is just making time for all of this activity, plus the run the business stuff. And for many banks as well, they have the challenge of dealing with the legacy loans that were issued during the boom years that now need to be worked out. So it's a very challenging time to be involved in bank management, for sure. If you look at the reports that have been published on both the rules, but then also the practice of regulation, I think you clearly see two things going on. One is that there wasn't enough capital in the system, and the rules on funding and liquidity weren't conservative enough. That's changed. The practice of regulation, well, of course, it's only ever the failures that get highlighted. And if you look at some of the reports, the faults are pretty much common across different countries. But actually, of course, there were regulatory successes that don't get talked about because it's not in the nature of things to have an investigation into a success. So I think it's a combination of the two phenomena, really. Practice not being great in every case, but also being good as well. And then the rules not being as tight as they should have been given the risks that the banks were running. Were auditors challenging enough of the financial information they were receiving from banks in the period running up to the crisis? And then the other is the rules themselves, and were they adequate for the types of risks that banks were running? A very specific example is how future loan losses get incorporated into financial statements at any point in time. I think it's recognised that the kind of incurred loss model has some flaws, and people were looking or wanting more forward-looking measures of loss as well. But again, practice varies across banks. There's some excellent examples of auditing practice, and then some examples where perhaps auditors weren't as challenging as they could have been. But again, what happens to the rules in the future will be important too as well. In terms of what happens in Europe and the impact on banks, I think you've got two things going on. So you've got the immediate impact of the ongoing crisis in the Eurozone and the effects that will have in terms of day-to-day market pressures, share prices moving one way one day, another way the next day, the same with the euro. But then you've got the underlying economic issues, which are fundamentally more important to banks, because it's about whether they're going to get paid back on their loans, and how the economy performs will clearly influence that. So how the crisis goes will be important towards sentiment and how the economy performs, but I think it's recognised that there are underlying economic issues that need to be addressed, and underlying economic performance needs to improve, really, for banks to move forward. So I think the two issues can, to a point, be separated and need to be seen as separate at points, but clearly linked as well. So if Greece leaves the Eurozone in the next couple of weeks, that's going to be in a scenario that's probably quite disorderly, and the sort of first round effects you would see are people saying, we don't know where the risks are for example, in the kind of European banking system. We're just going to take off risk for this period of time, and you might get a sort of Lehman type situation where the normal markets cease to function in the normal way. They're the first round effects. The second round effects, you could see some impact for those Eurozone countries that are perceived to be in a weaker position, and they might come under additional pressure in that scenario. Some people say that Greece leaving might actually help cure the problems, because it would just remove the most obvious source of weakness within the Eurozone. The truth is, no one knows, but I think it's pretty safe to say that a disorderly exit for Greece would have a number of problems, and that's why so much time and energy has gone into trying to make sure that doesn't happen. Officials around Europe have kind of worked with financial institutions to talk about a range of scenarios and what needs to be done in those different scenarios, and there are, of course, things that individual financial institutions can do to make themselves more ready for that kind of situation. But of course, it's always different in the reality, and the financial system is so complex, as we saw after Lehman's failed, that there are just some things it's very difficult to plan for. But I think the experience of the last few years has, if it's done nothing else, made financial institutions much more able to cope or to respond to those sorts of challenges when they arise. The Irish story is a very interesting one because it's one of the few countries, that's been in difficulties in the Eurozone that actually has the underlying economic story is a very positive one. You know, it's a net exporter. It's got some very successful large companies manufacturing there and selling abroad, and that is great for the future of the country. At the same time, you've got the legacy that will be there for a number of years to come, of course, of working out a very significant housing boom. So you've got a kind of two-track story going on there, and I don't think that the former, around the export-led success story, gets as much coverage as it deserves. And actually, I think it's very clear from what you've seen in terms of market reactions to Ireland that, you know, the actions policymakers have taken there have been well regarded, and even in this kind of recent uptick in the crisis, you know, Ireland has performed pretty well. I mean, the UK, again, you know, it's not a dissimilar story to Ireland in terms of there's being a property boom here in the UK as well, not to the same extent as in Ireland. Those just take a long time to work out, and you've got the process here at the moment of households deleveraging, the private sector deleveraging, and the government deleveraging simultaneously, which is going to make it difficult for the economy to grow at rates which we saw in the sort of late 90s, early 2000s. So, you know, again though, the underlying story I suspect in the UK economy is a positive one. You see stories coming out of, say, the car industry, where, you know, very strong sales for people like Jaguar, Land Rover, and so forth. So, you know, again, it's a complex story. One can't generalise, but I'd say, you know, over the long term, both economies very firm foundations. In terms of the UK recovery, clearly the big threat is what happens in the Eurozone and any dislocation that has on the economy here, either because, you know, it just dampens the sentiment of businesses towards investment, or because of the complications for the City of London if there's a kind of disorderly breakup of the Eurozone, or indeed if the crisis kind of continues for a longer period. But I think it's more the impact on sentiment here of the UK's main export market, the Eurozone, continuing to struggle. That's also true of Ireland. You know, the Eurozone is its very significant export market as well, and if those markets aren't performing, then by definition companies that sell there are going to struggle.